Welcome everyone. Yeah, it certainly is a topical issue. I think 3 of the presentations today talk about the same thing, so hopefully we're not too repetitive. I'll get into who we are. CFMG Capital, we were founded in 2008. Originally we were involved in land syndication. We then changed our structure as we went, but importantly I guess we're a land developer and also a fund manager. And importantly, through that time, since 2008, we've operated through a number of market cycles and have a 100% performance track record in that period. So just get through our disclaimer. I'm obviously not licensed to give you any personal advice or things of that nature, just to give you factual information about our products. A little bit about me. I've been working in financial services and property for a little over 20 years. I've been with CFMG Capital since 2012. And I've been coming along to these self-managed super fund empowerment days since about 2017. So apologies to those of you that might have heard me speak already. I do try and change my topic a little bit every year. But this year it's brand new because we're talking about private credit and we've got some new products in our range. I won't stand here and bore you by reciting bullet points. That last one though is important. Definitely don't know what spare time is. I've got a 10-year-old, a 13-year-old, a 15-year-old and one turning 18 tomorrow. So I thank Darren for the week away, planning an 18th birthday party at my house tomorrow night. So Darren is my favourite person, not my wife's favourite person right now. So I'll be returning to that party tomorrow. So private credit. Estimates put the private credit market just in Australia alone these days at over $200 billion. Sorry, I didn't skip. And moving along to what the attractiveness of private credit. What I'm talking about there with the previously inaccessible markets is, I mean small retail investors and self-managed super funds through private credit can now get exposure or investment exposure to property development returns and other sectors that were traditionally reserved for high net worth investors or even ultra high net worth investors. So what is private credit? Sometimes referred to as private debt, but contrary to a lot of opinion, it's not lending of last resort. It's in fact a far more efficient lending these days with more specialised expertise. Often a business will prefer to deal with private lenders as they are better to work with than the banks these days. And thanks to the competitiveness of the market, there has been significant rate compression. So the rates aren't significantly different like they once were between borrowing from the banks and borrowing from the private market. There's also been some regulatory change since the GFC in 2008. That's restricted some bank lending and more specialised private investors now fill this gap. So talking about the structure of private credit, something that previous speaker was mentioning about direct property and things like that and liquidity events, but obviously if you're investing directly in property, for example, that requires some equity but significantly and comes with significant debt. Then often you'll be playing the game of balancing the desire for yield against the expectation of capital growth. And on some occasions, it is hard to believe over the last sort of 10 or 15 years, but there has been capital loss events in residential property despite the boom times we've been in. Even in the last 5 years, there are small pockets of residential markets across Australia where people would have realised capital loss, particularly some inner city apartment pockets and some of those mining towns that experience really peak demand for a short period of time. And now, unlike every other part of the country, are actually experiencing oversupply. So liquidity, the reality of liquidity in something like direct property investment, it will still take time to sell. So you often will need to manage tenants, or for a quick sale often means that you're not going to be realising full market value because you're liquidating an asset, which essentially means you're not getting that market value. Contributory schemes also face the same type of liquidity concerns, but they're at least governed by the terms of the loan. So if you're in a contributory managed fund of some kind, there is typically a single asset in that fund, but it still has a planned liquidity event, which could be the refinancing of the loan or the sale of the asset, but at least you've known it's a planned liquidity event. So taking a look under the hood, there are differences between different types of private credit. We've got pooled schemes and contributory schemes. Interestingly enough, the rating agencies, for example, they hate contributory schemes, and the advisor networks much prefer the pooled schemes as well. But when you're investing in what the difference between a contributory and a pooled scheme? Contributory means you're investing in a single existing asset that the fund declares and has already identified, in some cases purchased, and they're telling you all about that asset and how they're going to manage it. Whereas a pooled scheme is a whole pool of assets, and you'll be pooling your money in both cases. But in a pooled scheme, they'll have this pool of money, they'll have an investment criteria, but then they'll go and unilaterally make decisions through their investment committee on what assets to buy through that pooled scheme or where to invest those funds. Whereas a contributory scheme, you know exactly where it's going, and there are pros and cons for both. But essentially, if you like a contributory scheme, you're investing your trust in that asset. So you might have knowledge of the asset if you're an expert in that market, and if it's a commercial office trust, you might look at it and think, oh, well, the tenant's the ATO or a government tenant, so you're pretty confident they're going to pay the rent. Whereas if it might be a Bitcoin spruiker or something like that, you're not so sure that they might pay the rent. So you're looking at that asset. Whereas when you're investing in a pooled scheme, you're investing in your trust or your belief in that asset manager to manage your money for you, and then their expertise in the markets and the investment criteria that they've set out. Then you've also got the different levels of security: first mortgage, second mortgage, mezzanine. Simply a waterfall of capital, capital stack. So obviously first mortgage, pretty simple. You're ranking first. If there's a liquidity event or an asset sale, or you're ranking first, so you're getting your money out of that fund first, which is the strongest security you can have. Second mortgage and so on. But I guess you've got to look at who the borrower is. So not all first mortgages are equal. It comes down to the quality of the asset. What is the borrower's capacity to pay the debt? What is their track record? Have they completed a project or managed an asset of that kind? And importantly, does the manager have the expertise to fix things if it goes bad? So having a first mortgage gives you the right to, usually in most lenders' cases, they'll just sell the asset. Are they going to realise the best value for it? Can they step in and fix the asset or manage the asset to get its maximum value? So all these things are important when considering what you're investing in and that first mortgage. So related party versus unrelated party. Certainly related party lending does have some negative connotations, but in our view, it can be very positive, and certainly I'll say that because nearly all our lending is related party lending. In the property sector, for an unrelated party, it means the lender will work with a property developer who needs money to progress their development. So they'll create a pooled scheme, then they'll go out to the markets and look for developers who are looking for money. In our view, this approach does create potential issues. Some good examples to look out for. Certainly I'm on the database of nearly every private lender in the country, and I do invest my money not just with CFMG Capital but other private lenders. And I do see offers come out where a developer might be putting up their principal place of residence as security for a loan instead of the actual project asset itself. I see that a little bit, and to me it's a quandary. On the one hand, it means the lender hasn't rated the development asset as good enough security. But on the other hand, it means the borrower is essentially putting up their most secure asset they own, so they have a really strong belief in the project because they're putting their family home on the line. Having said that, if I was looking at a loan like that, I'd want to see some pretty strong returns. Also, I have worked in this space previously on the other side of the coin, when I was a young bloke in my early 20s delivering or managing projects. In terms of that transparency piece, I would submit reports to my superiors up the line which would then go back to the bank or the lender, and then I would see that report a month and a half to 2 months later, and some of the information I put in had mysteriously disappeared. So you don't want that, whereas if it's a related party, you've got through the line full transparency of what's going on in the project. And I guess it's that alignment of interest. Sorry, I skipped ahead. Yeah, so full alignment of interest. If a loan goes bad or an asset goes bad or a project goes bad, it's our equity on the line. It's not just the investors. So skin in the game is really, really important. So projects that we lend on, we've built them from an embryonic state. So we have identified, we've assessed it, we've acquired it, and we're now ready to deliver these projects when the private credit's invested. So we know the projects inside and out. And investor outcomes for us are key. They're at the forefront of our decision making. In terms of our development arm, we can take and have taken unpopular decisions in order to protect investor interests. We can make hard calls, whereas some developers, if they've borrowed from a third party or a private lender, it's not their reputation at stake. They won't put their development reputation on the line in order to repay the debt, because they want to maintain their developer reputation as opposed to their borrower reputation, because one's a market-facing and one's a private-facing arm. And to us, though, because we are the borrower, or we're both the borrower and the lender, our 100% track record of performance, since inception, is one of our most important metrics. It's the key to our business, and our investors trust us because we've repeatedly delivered, even in the tough markets. Also, from an origination perspective, some larger developers these days, they're setting their minimum project size at 1,000 lots, which is great for us because it's reduced competition in that middle market phase, because they're seeking scale only, where we're seeking value. So for us, we have a 10-lot subdivision right now that we're about to complete in the inner ring of Brisbane, and the land in that project, we're selling those for $2 million a pop. Whereas we also are launching right at the moment a 700-lot subdivision in the northern outskirts of Brisbane, where land's starting at about $300,000 or $350,000. So that size and structure allows us to consider deals and work on deals across the whole spectrum, rather than just having a really narrow focus. So our investment model, we have three types of products. I'll go through a little bit of in a little bit of detail. The monthly income fund, so it's returns through secured loans on those active projects. So it's essentially replacing the bank on a construction loan. So for us, when I talk about construction, we're not building apartments or doing townhouses, we're just delivering infrastructure. So we'll go out and buy a 10 hectare parcel of land in a development area in a major capital city. 10 hectares usually comes out to about 180 lots. So we're delivering the roads, we're upgrading sewers, we're building intersections, building stormwater, delivering power. In Melbourne, we used to deliver gas, don't have to do that anymore. So that's what we're doing in those projects. The Land and Opportunity Fund, for that's where we create our value through the development. And that's been our flagship fund since the start. And that's where we're just taking a real valuable asset, like a real property, and we're just creating new value through development. And then lastly, our First Mortgage and Income Fund, it's creating value by taking an asset and improving it through rezoning and development. So we don't use those funds for any kind of development or construction at all. It's sort of short-term land banking, for example. So I'll give you an example for that. Actually, no, I don't want to skip ahead. I'll go through each one in a little bit more detail. So the Monthly Income Fund, we launched that in 2024 this year, sorry, March 2024 this year. And we've got over $20 million of investor funds deployed across that portfolio as we phase out the banks. Gives us a more efficient development pipeline. We still do have pre-sale hurdles. It's not just a loan and do what you like. And we have standard loan agreements. But this product was actually developed largely in response to the huge demand from our existing investor base, who's been investing in our Land and Opportunity Fund for 10 plus years, who are looking for a regular income stream. So it pays a monthly income, hence the Monthly Income Fund name. And that investor base, there are funds like that out there, but that investor base were looking for a monthly return from a manager they trust. So we responded to that demand because we were already working in that private space, wanting to phase out the banks, so why not do it ourselves, particularly with that demand from our existing investor base. That Land and Opportunity Fund, it's an experienced, reliable team with a really strong track record. It has been our flagship fund for a long time. And the targeted returns in that are based on some significant inputs and assessment. So the key metric, so when we're looking at a project, what's the key question we're asking ourselves is, does the opportunity or that project provide an appropriate forecast return at or above our target if land values at today's date remain as they are. So we're not relying on the market growth. We're not looking for a property boom. We can operate through any market cycle. If the answer to that question is yes, then we can start a much more detailed analysis. The analysis inputs, we do a lot of stress testing. So what does the model look like if land values decrease? What does the model look like if construction costs increase? What happens if both costs go up and values go down? And I'll give you the tip, nothing good happens when that happens, but we still check it and we model it. And if it's still showing a significant margin above what our investor return is, it just becomes our equity and our risk when we model those things. We have things like there are projects we've done, got one at the moment. In Queensland, a big deal is koala mapping. They want to protect all the koalas, which is fair enough. We've got a massive body of pine trees on one of our projects and it's got koalas mapped all over it. And last time I checked, koalas don't live in the pine trees, so we have to fight with council to remove those trees because they've just done a top-down view, seen a bunch of trees and assumed that that's where the koalas are. We also have things like credible and uncredible infrastructure upgrades. And these things like this, if you don't know what you're doing, can really make or break a project. So we might deliver a 150 lot project in a sort of medium ring suburb, and as a result of that, we have to deliver a huge infrastructure upgrade or an intersection upgrade, put traffic lights in, widen roads, things like that. When you're doing your infrastructure agreement with council, you need to make sure that it's creditable, and if it's not creditable and uncreditable, you need to build that into your model. Because if you deploy the capital to build the intersection and then you find at the end of the project it's not a creditable intersection upgrade, that money's out the door, you never see it again. And if you haven't modelled that properly, it's a huge impact on your project. So getting your infrastructure agreements, and this is where amateur or sort of first-time developers can really come unstuck if they're not experts in the space. But understanding what's creditable and uncreditable is really important input into your modelling. Of course, there's also traditional things like in Victoria, there's bushfire modelling. We have a little bit of that in Queensland. But then in Queensland, there's flood modelling. So making sure you know where the flood lines are, particularly in the last 20 years in Brisbane, we've been underwater twice. So we've got to look at those things in key detail. And finally, the first mortgage and income fund, it's not used, as I said, to fund or operate any development. So we might be land banking assets. So we'll buy and we'll identify a site that we think is ripe for development, but for some reason it's not zoned correctly by council or there's no approval. So we'll buy it, we'll raise capital on a as-is, where-is valuation with a low LVR. And then we will then spend 12 months trying to get a rezoning or an approval. Once that's achieved, it would then move into Land Opportunity Fund at its new book value. If it's not achieved, we have to consider what we do after 12 months. And because we've borrowed it against an as-is, where-is valuation, chances are it definitely won't have gone down, might have gone up in value, but we can sell it because of the low LVR. If we haven't got the approval, we'll probably do a little bit, we'll lose a bit of money ourselves. But because the investors have got a first mortgage, they'll retain that first mortgage at the 70% LVR and be paid out plus their returns. Good example of that is we bought a site recently in Brisbane. It's at a sort of medium ring suburb. It's only a small project. The site costs $3 million, so at a 70% LVR, we borrowed or raised $2.1 million on an as-is, where-is valuation. In that particular case, the only time in this fund that we've done it, we weren't successful in getting that development approval in the first 12 months. So the options after 12 months were to sell and return investor funds plus their forecast dividends, or raise reinvested capital and continue and have another go. We decided in that case, we thought we still had a shot at a development approval. 90% of the investors chose to roll over the capital. We paid out the others, brought in some new ones, and then 6 months later we were successful in getting the development approval. Then of course the site value is suddenly $4.5 million. And it moves into our Land Opportunity Fund, and eventually it moves through our product cycle, and also we'll borrow from the monthly income fund when we deliver the project. So here we are. Very important, particularly for some of the related party transactions that we're doing. You've got to have independent directors. So Ross Stiles, our chairman, he was the founder of Cromwell. If you know Cromwell, they're now a global asset manager with a market cap over $1 billion. Barry Adams, he's an independent director as well, regional commissioner for ASIC. My time's up, so I won't go through them all, but We do have over 1,200 investors, and we've got over $100 million of funds under management. To us, that's a big number. Obviously, you're hearing numbers in the billions, but we're a boutique manager that has investor, we're lending across only our portfolio. So if we were to then, raise exponential amounts of money, the issue there is you've got a burning hole in your pocket and you're just looking for loans, you're looking for people to lend money to. And then as soon as you've got funds burning a hole in your pocket, you start to make questionable decisions because you've got to get the money out the door because you just keep raising exponential amounts. Therefore, you've got to lend the money and you're putting those funds at risk. Some of our completed investments through the Land Opportunity Fund in the last 5 years, but I think the most important thing there is since inception, the Land Opportunity Fund has returned over 50 million in capital with an average weighted return of 11.68%. And our First Mortgage and Income Fund has returned over 10 million with an average weighted return of 6.45, all as forecast. And the Monthly Income Fund, only been operating since March 2024, has delivered its 8.25% per annum on a monthly basis since inception. So if there's any questions, I'd welcome them. Otherwise, I'm pretty much the first booth you see when you come out of the list. So you're welcome to come and check because I have gone over time, which I normally do, but I think guy before me pushed into my time, so that happens. It happens every time. No questions? That's good. I'll hopefully see you at my booth.